Hello and welcome. I'm George Burns from Evolve Property Partners, and today I want to run over the property strategies. This is 4 topics that I want to cover. There's the first one, which is a list of the property strategies. I get asked a lot, what can I do within the property world? What are the strategies that are available to me? So I'm going to list a general idea of kind of the focus or the main few that I have worked towards or know about. Secondly, the 6 core property strategies. So these are the main ones to begin with for beginners or even maybe a little bit of experience. Ones that you can learn a lot more about. There will be opportunities later that I can offer so you can learn even more about that work with me a bit closer, but we'll get into that. And number 3, once you go into your business pots, your business pots will determine the strategy. Okay, so it's something that we can run into a little bit. I do advise whenever you're looking in property to start a business, develop a goal or look at what your goal is, and then you can look at what your plan is, and your plan will determine your strategies, or your strategies may even determine your plan. And then number 4 is the strategy for your situation. So we'll talk about what each strategy contains in terms of the finances, what each strategy does, so the business pots, for example, where if you're looking at cash flow, there'll be certain strategies to focus on. So we can go into that together to really understand what is best suited to you. So let's have a quick overview of the strategies. So these are just generally listed out. I'm going to go into a bit of detail for each one. Hopefully it gives you a good insight. So the first 6, as mentioned, are the core 6 that we will go into even further detail. So I'll run through them quickly. So we've got number 1, which is buy-to-lets, 2, which is buy-refurbish-refinance, also known as BRR, also known as BRRR. Do you know what? I'll even add that to the sheet. BRRR. The third R stands for rent, so buy-refurbish-refinance, rent. Number 3 is property flips. You buy a property, sell a property, make profit, hopefully. Number 4 is deal packaging or deal sourcing. There is a difference between the two that we'll delve into soon. Number 5, HMOs or houses of multiple occupancy. Number 6 is rent to rent. I've also gone into a bit more detail with rent to rent. So 7, 8, 9, which I do include, by the way, in the 6 core, are rent to SA, rent to HMOs, and then rent to housing association. There are 3 other strategies that we can do. Just very quickly, rent to SA, service accommodation. So that's renting out per night, or you can book longer, but you pay per night, basically. Airbnb, booking.com, that type of stuff. Rent to HMO is booking out per room, per night, or just booking out per room 2 people. And then rent to housing association is putting it onto hopefully or usually a government-backed housing association, which will usually pay more than what the rent is. But there's plenty of factors to that. Again, that's a bit more of a complicated strategy. Okay, so there's 11, I believe, here, where we can go into a little bit more detail. If any of these, or if you're looking at these and going, I'm not interested in any, then just skip this part and we can head into the next bit where we're talking about the core 6. So title splits. This is the idea of buying a freehold block. We're doing one at the moment. So you purchase the block, then what you do is you split the titles. So with that, there's stuff to focus on, such as the utilities, the properties being registered, the council tax, etc., etc. But the idea of you buy the property as a freehold, the way to add value is split them into flats, have another company that owns the freehold, each one is a leasehold, and then you can either sell them on, or hopefully if the value's added enough, you could refinance and keep the majority or all of the now flats. Number 11, property trading. This is the idea of not purchasing a property, but exchanging on a property and then either putting it into a auction or selling it online. So you're trading the property, and the difference between what you exchange on, what you complete on, or what you sell it for, that's the profit that you make within that. There's companies built that specifically target that. And there's, again, I won't go into too much detail, but there's loads of ways of working towards that. Number 12, commercial conversions. To put bluntly and to put simply, is buying something commercial, converting it into flats or residential or something along the lines of. Number 13 is land development. I think that's quite self-explanatory. You buy land, you develop on the land. It's quite a long-term strategy and requires quite a more when it comes to the finances. Number 14 is land banking. So that is purchasing land and basically banking it, leaving it, not doing anything with it. Hopefully it goes up in value. There's certain factors that you can do to that to add value, which we can get on to sort of the number 15, which is a bit more detail. And then you sell that in the future. Number 15, buy to sell with planning gain. So you similar to land banking and very similar, but you buy the property or buy the land with the basis that that will get planning in the future. As soon as you've got planning, you basically sell it. You can do that with land banking as well, but you don't buy it. So you can exchange on land, get planning, and then sell it. 16, lease options. So a lease option is where you would speak to a vendor, you would kind of exchange on the property, or you would work towards the property, maybe rent it from them with the option to purchase in the future. So you might say, right, that property is worth 100,000. Maybe they can't keep up with the mortgage, so you will take the mortgage on. You will then do the property up. You would then put it on Airbnb maybe. And then in 5 years or whatever the agreement is, you would then buy it for the amount you agreed. The idea is with that, you make monthly income, but then you can put £1 down or something silly. And then in the future, whether that's 3 or 5 years, the property's gone up enough in value and you've made enough that it covers a deposit. So when you do purchase it, there's a difference there that you're getting the property for a lot less money in. Okay. Number 17 is an assisted sale. This, as an example, is where you might speak to somebody you maybe exchange on the property, or you have an agreement in place where you take the property on an agreed price, but you don't pay that price. Then you maybe do a refurb, or you add value to the property. You might convert it many different ways that you can, and then you would sell the property, and then they get their fee, or they get their whatever you've agreed at the start, and you get the additional and your money back. You might even do an assisted sale with a profit split to say, right, I will pay £100,000 when we sell it. We're going to do £20,000 worth of work, whatever additional to that, we will split on a profit split as well. Number 18 is service accommodation in general. The reason I've put service accommodation in housing association away from rent to SA and rent to HA is because you can do that without renting it. So you could buy maybe a house and put it onto the housing association to increase cash flow, or service accommodation depending on the area and the amount agreed. So you can do that as a strategy itself, where you buy and then put it onto that. And then number 20 is joint ventures, which is worth just mentioning, where you would look at a company. You can either purchase a company on a joint venture, so you purchase shares in that. You could put money into a company where you own 25% and you all put 25 grand in, for example, and then that's a joint venture that you can go out and pick many of the other strategies to focus on. That could be rent to SA, it could be just standard buy-to-lets, it could be any of the above, but a joint venture nonetheless. So that's a brief overview of kind of the top 20 strategies that I know of. There may be some more out there. There may be opportunities to kind of mix these together, but in general, these are the 20 that are focused on, and these are the 20 that are out there currently. Each can be profited, each can be looked at, but as I said, these kind of final 10 are a little bit more complicated than the first 6 to 9, if you like. So let's delve into the 6 core strategies. These are the ones that I would be looking at if I was fairly new, or even maybe a little bit experienced and wanted to gain property knowledge, wanted to gain some money, whatever that looks like, and wanted to build a business and to start generating, whether it's income, profit, or long-term wealth. Again, we'll get into that. So buy-to-let, a quick overview of what buy-to-let is. Again, hopefully most people will have heard of buy-to-let. I think buy-to-lets and flips are what most people have kind of understood when I've spoken to investors or spoken to people that maybe want to get into it. The main one is just buying a property and renting it out, which is buy-to-let. And the second is property flips. It's buying a property, adding value if you can, and then selling the property. But there are kind of a few different ones. Also with this, when I've spoken to people about property flips and kind of understanding why is it you want to do a flip, when you delve into the conversation, you realise actually it's not the flip that you're doing, it's the lack of knowledge of the other strategies. It's just going, I want to do a flip because it looks sexy and you can make money. Well, again, you can. It's not sexy, it's hard work, but there are other strategies to pay attention to. So work out the goal, work backwards, reverse engineer, etc. Again, we'll get into that soon. So, buy-to-lets. The strategy involves purchasing a property to rent out to tenants, generating rental income and taking advantage of capital growth. Okay, so you buy a property, you put down a deposit, maybe do a refurb, whatever the case might be, and you rent that out, and the rent should be more than your mortgage. Definitely should be more. And your net rent after your costs should be a positive number as well. You take advantage of a rental income, you also take advantage of the capital growth on that property. So why would you use it? So it favours its potential to provide steady income, like we said, a passive income. When I say the word passive, I'm going to do quotation marks, so it's not passive, but it's as close to passive that you could probably get to. And then the long-term capital appreciation as well. blah, blah, blah. So it's popular choice for those seeking to build a rental portfolio. So yeah, if you're wanting to build a portfolio, wanting to make a good cash flow over time and wanting a property or wanting your funds somewhere stored that is quite safe, fairly low risk depending on how you do it, and then goes up in value over time whilst being able to leverage with mortgages, the buy-to-let strategy is very useful. Very, very good. Buy-refurbish-refinance, or as I said, BRRR. So what this is it involves buying a property, usually renovating it to increase its value, okay? But it's not always the adding value on the renovation stage. You could add value by buying it for cheaper, for example. And then what you do is you refinance to pull out the increased equity. A very simple way of this, if you buy a property for £100,000 and it's then worth 120 on refinance, you would pull out £15,000. Irrelevant to if you spent 5, 10, 15, 20,000 to get it to that. The increased equity from purchase to the refinance value, 75%, that is drawn back, as long as you tick the criteria of rental, etc. So why do we use that? So the BRR allows us to recycle our capital quicker, basically. So it allows opportunity to purchase more properties, which grows the portfolio quicker. So the improved value usually increases the rental income as well, because you'll be able to rent it for more because it's a nicer property. But it also decreases the cash left in the deal. So if you were spending 25 to purchase a buy-to-let and £10,000 in buying and refurb cost, you're £35,000 in. If you were to do that, but the value of the property is then 120, you get back the 15,000. You have the 35 on the buy-to-let. Take the 15,000 that you get back. You're actually spending 20,000 on that example. Okay, again, there's more to that, but that's a very simple way of putting it. What that does is it increases the return on your investment. Okay. Number 3, property flips. As I said, this is something most people know about. There are a lot of nuances to this strategy, but in general, it involves purchasing a property, renovating it, and then selling it for a profit, hopefully a bloody profit. So why do we use this? So this strategy offers short-term profits. So when I say short-term, we're talking usually on a flip, it's around 12 months. So if you want your funds to be liquid in 12 months or 12 months onwards, you would want to do a property flip rather than buy and hold, because your funds are tied up in the property then. Okay. So yeah, the average time frame is roughly 12 months, which includes 3 months to buy, which can be anywhere from 1 month to 3 months, but usually it's 3 months tops. 4 months to renovate. Again, that can fluctuate, but this is a general idea of what we do on our properties. 1 month to sell and then 3 months to complete on the sale, because usually we sell to the residential market. So people will be getting a mortgage, and usually that is 3 months complete. And then that adds up to 11 months. So I've put a month for contingency before people go, that's 11 months. Number 4, property sourcing and deal packaging. Again, there's a difference between the two. One of them is mainly focused on finding a property and sending it out to a list of investors. The other is more focused on working with an investor for a criterion, going out and finding them the property. So it's either a property finds an investor or an investor finds a property, and you match them together. So this strategy, it requires less or little capital. We'll go into how much you kind of need for that. And you can make good money quite quickly, which is good. It also allows you to grow a network, grow a power team. You also build knowledge within property, which is essential. And then you eventually can use that knowledge to invest yourself, and also with your network, you might get better properties that you can then pick and choose. Okay. Number 5 is HMOs, which is houses in multiple occupancy or houses of multiple occupancy. So HMO is a property that's rented out to multiple tenants. Okay, so each would mainly have their own bedroom, but they share common areas like the kitchen and potentially bathrooms. Some HMOs have their own bathrooms as well. So the reason people do HMOs is it generates a higher rental income compared to standard buy-to-lets or standard rentals, because you have multiple tenants paying the rent. Usually you will cover the bills. With these, because it's more of a commercial strategy than than the other strategies, residential or buy-to-let or whatever the case might be, you usually need a high deposit. So it's 30%, and the valuation is on a commercial valuation. So you're pushed more towards what the rental is rather than what the house value is. You don't refinance on a bricks and mortar. You usually refinance on a commercial valuation. Number 6. rent to rent, which includes rent to SA and rent to HMO. I'm not including rent to housing association on this for multiple reasons, but rent to SA, rent to HMO. So rent to rent involves renting a property from a landlord and then subletting it to tenants. Rent service accommodation targets more short-term rentals, vacation stays, such as Airbnb, Booking.com, all them sort of websites. And then rent to HMO targets multiple occupants in a HMO setup. So you would rent the property maybe as a whole, and then you would rent it room by room to hopefully create a bigger discrepancy between the two, and that is the profits. So why do people use this? So rent to rent, the strategy requires probably the least amount of capital out of all of them, give or take. That and the property sourcing / deal packaging. It allows you to generate the rental income without owning the property. So you're taking advantage of an income, you can build that without having to put a deposit and etc. down. Rent to SA can offer higher income if done properly, especially in the tourist areas. So rent to SA is mainly focused around the area more than anything, and then rent to HMO, although is focused around the area, will be that's area to be honest, but you need more bedrooms in a HMO, and you need it to be in certain areas. Again, there's Article 4, there's certain stuff that requires certain certificates and passes, etc. to do that. Cool. That's the 6 summed up, really. Hopefully that gives you enough information to go what it is, what you might look at and go, that looks interesting for whatever reason, and we'll go in a little bit more detail further on, as I said. All of these are stuff that we do. I've not really done too much in HMO, if I'm completely honest. I prefer other strategies personally, but all of these do work. All of these can create either income, profits, or wealth in the future, which we'll go into now. So the business pots, this is something that we need to really look into when we're developing what strategies are best for us. So let's just forget property for a minute. Okay, so we're looking to build a business. That's what this is. We're just using property to make the money. So something that I quite like is when we simplify is we're looking to build a successful business, and property is the vehicle to create the success. Okay, so the 3 pots within our business that we need to think about are cash flow, profits, and wealth accumulation. So it depends on where we are in our certain situation. So for example, if we're working a job at the moment that we enjoy and we've got a little bit of time but we're earning good salary, we might go, well, we're not too focused on cash flow. We're more focused on putting our money towards buying properties for the long term, to take advantage of the capital growth, maybe leave a couple of properties to our children. Okay, or we might be in a position where we've got £100,000 in a bank. We've got no time really to do much. What we want to do is we want to put that £100,000 into whether it's a business or it's a joint venture, for a bit of help with knowledge and etc. of doing the work, buying a property, flipping it, making that £100,000 into maybe £110,000 to £115,000, and having help with that. That might be what we prefer. There's many different ways of creating money, but our situation is going to be different. So again, there's a little bit of information here that we can do, and a couple of examples that I've got where we understood what was best suited for the investor we were working with. One thing to really push and echo is whichever pot we're looking to focus on, it doesn't happen overnight. So whether that's cash flow, good profits, or the profit pot, or wealth accumulation, it takes time. Okay, and when I say it takes time, we're not talking months, we're probably talking years. So once we've decided on the strategies that are best suited, once we've understood what pot is better, we need to understand the value pillars. Okay, so what we can bring to a business. It might be that we own the company on our own, we might joint venture with people. So we either need to partner with others within the company, or again, we might need to outsource components of the company. So the business plan will determine this, okay? So the 4 value pillars we need to consider are our time. So how much time can we put into it? Knowledge. So what is our knowledge on either the strategy, growing the business, property in general, whatever that might look like. Network. Are we well networked? Do we have a power team? Do we know solicitors, estate agents, letting agents, sources, or however we're buying the property, etc. And then capital, obviously. Do we have enough capital for the strategy? Okay, and each one will determine the strategy. Each one will determine what we can provide and what value we can provide. However, we can outsource. So, for example, we can outsource time. So we can pay others for their time. So whether that's you pay others for their time, where that could be using a sourcer, it could be using a building team, a project manager, whatever that might look like, or it could be using someone within the company. You could hire an employee, or you could hire someone that's self-employed paying commission, for example. Knowledge, so we can learn. So we've got YouTube, we've got books, we can pay for a mentor if we want that more one-to-one side. If we want that more, like this, for example, is stuff that I teach people and we sit down and go over it together. You might go, right, actually, George, I really want to focus on the deal packaging side of things. I want to know how I can do that, how I can grow a successful business with that. Through that, I need to learn what's a good property, how do we find investors, how do we sell the deals, how do we ensure the deals stack up, etc., etc. Okay, so we can outsource knowledge, but we need to learn that as well. We could partner with sources, for example. They could go out and do that, which is using their time, but they've also got the knowledge, and we can bypass that and accelerate that. But we can learn. Okay. Number 3 is network. So the best way of growing that value pillar is by going to networking events. We can also ask for recommendations, which just accelerates that. Again, that's outsourcing. So, for example, you might come to me and say, oh, George, got a property, really interested, want to bridge it because we're doing a flip. Do you have a broker in mind that we can use? And I can say, yes, of course, here's the broker that I use. And then whether I get referral fees or not is completely up to myself and the broker, but I would recommend someone that I know can help you in that situation, or solicitor, or whomever that might be. And then number 4 is capital. As we've said, so the way to outsource that is we can focus on either making money, or we might have savings, or whatever the case might be. But if we don't, then we can partner with investors that maybe already have funds. So we can raise the funds through investors or business partners, and we can offer them either profit split, security, equity within the company, depending on the strategy. There's lots that we can offer investors. Okay. Another point that I just want to kind of reiterate is I have these conversations with investors or with people looking to build this business all the time. And it might be time, knowledge, network, capital. It might be any of them. And it's always, I can't. Okay, well, I just can't. I just don't have the time. Okay, cool. I can't. I don't have the capital. I don't have 100 grand. Cool. Change that to how. How can I create the time? How can I be more efficient with my time so I can look at this? Capital. How can I get hold of X amount, £100,000? And then developing the plan around that. How? How can I do rather than I can't because of? Okay. So this is the pots within the business and the value pillars. Each of these determine what we want to be doing. If you want to have a consultation call with me, I do offer free strategy calls between myself and you, so we can delve into what this looks like, having a general idea of the goal, and maybe building a little bit of a business plan to at least get going and to at least understand, right, which of these is best suited to your situation. And that depends, as I said, on time, knowledge, network and capital. And having the knowledge, I can provide what strategy is best suited to you and how you can at least kickstart that. So if you do want to book a call in with me, it will either be down below in the information bit or on the email. If you've received this by your email, a link that you can book a call in to my diary or work with the team into the team's diary, and we can have a bit of a call to see what that looks like. And if there is some synergy there as an opportunity to get you involved in any way, then absolutely we'll explore what that looks like as well. So yeah, please feel free to do that. I enjoy these conversations and exploring what's best for your situation. Okay, right, so let's give you a general idea that hopefully can kickstart you to understand your situation. So we've gone over the different strategies, we've gone over the different business pots, and we've even gone over the value pillars. So these are the main factors. Again, if you want to learn a lot more about this, please do book a call or get in contact. Now we need to understand which strategy is best suited to you or have an idea of that. So what I'm going to do is I'm going to put each of these strategies into what pot is best suited. So if you want to build a cash flow pot, we can look at that. If you want to build a profit pot, again, these are the strategies best suited. On a side note, just because I put one of these into a certain pot doesn't mean that's the sole pot that it is. Okay, so if, for example, flips goes into the wealth accumulation pot, which it doesn't, but let's say it doesn't mean that you're not going to create a cash flow as well. So there's the main pot and there's also a secondary pot. So let's get into it. So buy to let. Okay, so if you're looking to do a buy-to-let, that's because you want to increase your wealth accumulation pot. Okay, the core strategy for buy-to-let, especially with the interest rates how they are at the moment, the core strategy on buy-to-let is the long-term development. If you're purely looking at cash flow, for example, buy-to-let isn't what I'd specifically recommend. Okay, depending on what you need your cash flow to be. However, the wealth accumulation, you do get a cash flow, but you get a property that goes up in value. The rental goes up in value as well through the years. If you put your rent up 5% per year, over time, you create a really good cash flow. Again, I know we have inflation and you kind of, if it's going up 5% a year, and I think at the minute we're at 2% of inflation, you're kind of increasing that 3% a year, but it's still going up. Okay, a property that brings in £200 to £250 a month today may bring in £500 a month in 5 years. Okay. Buy, refurbish, refinance. This is also a wealth accumulation pot. So BRR for me is basically, it's a way of doing buy-to-lets, but you're utilising your funds further. So you can buy more for less. Simple way of putting it. Again, BRR is wealth accumulation and cash flow as well. It's buy-to-lets, but you're using a different strategy to get hold of buy-to-lets. Property flips. I would put property flips in the profit category. So you buy a property, and profit's usually around the 12-month mark. So you buy a property today, and in 12 months, you would make a profit on your money, as well as having your money back. So you have £100,000 today, you'd have 110, maybe £115,000 in 12 months. We do actually offer a service, an earn and learn service, where we would have a strategy called, if flips is the right one for you, we can do a flip project with you, where we would basically, say, do most of the work. We'd find the property, we'd hold your hand through the entire purchase depending on security, and then we've got a refurb team that would do the refurb, and then we'd sell the property. So if you do actually want to explore doing a property flip, you want to make some profit over the next 12 months, and you've got some funds available, as I said, click the link that you will have, and we can chat about that depending on, again, what value you can bring, what capital you've got, and the liquidity. Okay. Deal packaging and property sourcing. What I would put that in is probably the profits pot. So when you're deal packaging and you're sourcing, you are finding a property, you are putting it in front of an investor, and you're creating a fee from that. So if somebody came to me and said, I've got this fantastic deal, but I don't have the funds, here's all the figures, and it's in my area, hits my criteria, I would pay you for that deal. What I'd pay you is different depending on the service, depending on the type of property, the value, XYZ, but I would pay you for that service. However, the reason it's in a profit pot, not the cash flow pot, is one, it's an active income, so you have to work for that rather than creating some sort of passiveness. And number two, you would get paid on that deal packaging or property sourcing when that completes. If you're doing that in maybe deal packaging on rent to rent, that would be a very much a quicker service. But when you're doing a deal packaging or property sourcing on a project, either a flip or a BRR or buy to let, I would have to go through the process of buying, which can take anywhere from 1 month to 3 months, depending if I'm cash bridging or mortgage. So if you were to find me a property deal today and I bought it mortgage, you would get paid in 3 months what that looks like. Okay, you might get a retainer, but the full fee would come in 3 months. So you're looking at profits, a bit quicker than the flips, but still you're looking at profits. Couldn't get me words out then. HMOs, I would say the main focus on that is cash flow. Okay, so you still need some upfront costs. You still need to put, again, usually 30% down. You've got other costs, refurb costs, solicitor costs, buying costs, etc. But then because you're renting it by the room, you should be creating a good cash flow from that. So that for me would be cash flow. You've also got the wealth accumulation. Although bear in mind that is more focused on the rent than the bricks and mortar value. So you're then relying on the rental increase over time rather than the capital appreciation. And then finally, rent to rent, which for me, I believe, cash flow. You still need funds to be able to acquire rent to rent, but a rent to rent should create you a good or a very good cash flow, whether rent to SA, or rent to HMO, which apparently we're not focusing on. So that for me, or for the strategy, creates cash flow for lower amount. If you're purely looking at cash flow, usually you get leases at 3 years to 5 years. If you're purely looking at the next 3 to 5 years to create that cash flow, a bit of monetary coming in per month for whatever reason, you might be looking to quit your job in 12 months, and that would create that cash flow that allows that strategy. Okay. Finally, which is the bottom of the page, we have the capital. So for a buy to let, I'm talking more north, by the way. So bear in mind, people watching this maybe based in London or Cornwall or somewhere further south, your buy-to-lets, you will need more money because you're buying a higher value property. So the buy-to-lets, you need 25% deposit, buying costs, which include solicitor, stamp, and etc. And then you also need stamp duty, I think I said, and then refurb. Okay, unless it's turnkey, you won't need a refurb, and you can keep that £35,000. Most refurbs you're getting up to the 40 plus. If you're using a sourcer, you're probably hitting 40 to 45, by the way. BRR, usually you're going to add value on a BRR. So when you're adding value, you're creating a higher value for the refinance. So if you are doing this on bridging, or you are doing a mortgage and then refinancing after 6 months or 18 months, depending on the mortgage and the early repayment charges, the BRR usually consists of £45,000. You're doing very similar to a buy-to-let, but you're going to need to refurb. I have done a BRR for £35,000. It didn't have any solicitor costs. It did have solicitor costs. It didn't have any sourcing costs. But with that, what I did was buy on a mortgage, and then 18 months later, I then refinanced it. So it was basically a buy-to-let and a BRR because it was a longer stint between the refinance, but it was very similar to just a standard buy-to-let. I just created value and then refinanced. So you can do it for less, but you're usually going to hit 45 plus if you need a refurb to add value and if you're going to use a sourcer. Third one is flips. The majority of your time, you're going to need around £100,000 to do it properly. That includes purchasing, it includes refurb. Usually, when I say purchasing, it's deposit, and you're going to use bridging, which you can get anywhere from, you can get up to 90%, by the way, and that's net on bridging, which can help with costs. Then you've got the refurb, you've got other factors to pay attention to, so usually around £100,000. Again, you can do it for less. It depends on what properties you're targeting. For me, I target the kind of a little bit nicer than your terrace properties, so usually we look at semis and detached. Usually looking at, in my area, which by the way, I'm based in Leeds, so I look at kind of Yorkshire. We've also got a team in Manchester that are very similar. What we do is we purchase around kind of 200, we'll spend anywhere up to 50 on a refurb, and that should be worth 320 plus. So most of our flips will require around the £100,000, but you can do it for less. Deal packaging and property sourcing. Now we're getting into lower figures, which if you haven't got a capital and you don't want to raise funds, this might be an area to kind of think about. Deal packaging and property sourcing, you look at anywhere from 2 to 7. The reason I've got 2 to 7 is £2,000 you pretty much need to be compliant. Okay, so if you do want to do deal packaging or property sourcing, do let me know and I can go into what you need for being compliant, how you find properties, how you're finding investors to sell the properties to, all that information. And refurbs, really important, the refurbs. £2,000 to be compliant. If you want to really do it properly, you want to understand it, you will need a mentor or you will need to learn how to do it in a course. Most mentors at basic stages are costing around £5,000. My course is £5,000, for example. So if you wanted to do it, you can do it for £2,000. If you want to do it properly and learn, if you don't have that knowledge, you're looking at around 7 for that. Just to give you an idea, the average deal that we do when we are deal packaging is around £5,000. So if you are in and around 7, 2 deals, you should be making a profit. Okay. HMOs, houses of multiple occupancy. I've put of now, so it's in or of or whatever it is. But houses of multiple occupancy, you're looking around £50,000 if you want to just buy a turnkey HMO. Depending on the area, like I've said, if the further north you go, so if you're going up to kind of the northeast, you're probably lower than that, by the way. Okay, so you need deposit, which is 30%, and then whether you need refurbs or not, you might not, but then you've got buying costs as well. So you could probably do it for slightly less, but HMOs, depending on the rooms and the rent, usually you're going to pay a premium for because you're buying the commercial value, not the bricks and mortar. If you wanted to buy bricks and mortar, turn it into a HMO, you're going to require more funds because usually that's going to require buying and renovating towards a HMO. You're adding value by creating a HMO, multiple rooms. And finally is rent to rent. Again, includes rent to SA, rent to, again, I've done that, rent to SA twice, and rent to HMO. Okay. The reason it costs 7.5 to 12.5 is usually you need to find the deal. And this, you're paying anywhere from £2,000 to £5,000 for a deal. Okay, so bear that in mind. That's why I've got the 7.5 to 12.5. Or you get trained. If you know how to do that, you might save costs in this, by the way. So if you've watched this and you know rent to rent like the back of your hand, then costs will be lower. But if you don't, and you either want to get trained or use someone else and outsource their time and knowledge, you're talking 7.5 to 12.5. You need to furnish it. If it's already furnished, great news, you'll need to stage the property. Staging costs a few £1,000s depending on the bedrooms. You also need first month's rent. You also need a deposit. Most of the time you can get deposit insurance or you can negotiate, but you'll need a deposit nonetheless. And then it usually takes 4 weeks to get it going anyway. So you might even need 2 months rent to think about. So anywhere from 7.5 to 12.5. The good news, or what we target though, is usually we're at 12 months to break even. So if you put £10,000, which is in the middle, usually by month 12, you'll have broken even. And then year 2 and year 3 on a lease, you should be making £10,000 a year really. So it's you don't make money straight away, but you create a cash flow and then make money over, well, the lease length. So that is that. I have quickly just put up here Lovely, I'm in the way. The calculators that we use in-house. Okay, just this is the sort of stuff that we can run through if you do like the strategies or you want to jump on a strategy call just to understand how much funds you need for your area or how much funds you need moving forward. We have a buy-to-let calculator. We have a buy-refurbish-refinance calculator. We have a flip calculator, and we do have a mainly a rent to service accommodation calculator as well. They're the four that we have in-house. We do use the rent to HMO, but as I said, it's not a strategy I really focus on too much. So if you are somebody that has watched this and gone, do you know what, I'm really interested in learning a lot more about the top 6, really want to focus and want to build a business in property, whether you've got whichever value pillar you've got available. It might be you've got no capital, but you've got loads of time. You might have loads of capital, no time, no knowledge, or whatever case might be. We're here to help, okay? And if you do want to go into any of these strategies, a bit more complex one, we are looking for partners in whatever that looks like. So even if it is any of these, do let me know. As I said, the link should either be down below or in the email, depending on how you receive this. Book that free strategy call with myself or the team. We can delve into what this looks like, and hopefully there's synergy there to work together. But hopefully this is providing a lot of value, and we are looking to do more stuff like this. Please let me know, again, either email back or in the comment section, kind of what other stuff you'd be interested to learn about, whether that's how do you build your business plan, whether that's how do you use the calculators, how do you find properties, finding investors, whatever that might be. Please do let me know what you would hope to find out and learn a little bit more. And I can look to do a very similar bit of a presentation like this for people to, again, provide that value and potentially offer opportunities to work together. So, yeah, if you do want that, click the link. Hopefully we can have a chat. If not, hopefully I've provided enough value, and good luck with everything. There's definitely opportunity. It just depends on which strategy and which opportunity works best for you. So thanks for watching. Hopefully I'll speak to you soon potentially, and I'm sure we'll catch up then. See you later.